Welcome to this. This is our panel discussion on the first topic on the communication on financial stability topic. And in this session, we're going to explore how central banks communicate about financial stability from tranquil times to moments of crisis, and how that communication shapes market discipline, risk awareness, and also crisis prevention. I mean, it's picking up on a lot of the themes that we heard in the TED Talk that we just had now. Just for the audience, to prepare this discussion, and Stefan mentioned it already, our panel members had a sneak preview of a special feature that we published in the FSR today on the crisis prevention role of financial stability communication, and doubting that many of you in the audience had the chance to read it between the publication this morning and now. It creates an information asymmetry between the panel and the audience. So I thought, in an effort to reduce that asymmetry, I would spend just a couple of minutes on the main messages in that article. First of all, I'm going to single out three. First, communication can play a central role in crisis prevention because it has the capacity to influence market expectations, and it can reinforce trust. I think that was also in Stefan's speech. Second, transparency must be balanced against the risk of causing unnecessary volatility. Some of us will remember the famous Alan Greenspan irrational exuberance speech, which did actually cause financial market volatility and was one of the reasons sometimes governors gave for not publishing a financial stability review. And then third, feedback from a readership survey that we carried out in May. I think it really underscores the importance of adapting communications strategies to different audiences. We carried out this survey. We had 86 responses. I'm told that this is a decent number for a survey of this kind. If we're taking a very selective look at it, it confirms that the readership of the FSR is broad. So if you look at the left there, most readers are in central banks and they're in the financial industry. But we did also get responses from readers who were working in other fields, so including academia, international organizations, the media, and others. Now, when it was launched 2 decades ago, there was no macroprudential policy framework. So there was a lot of faith was put into the ability of communication to inform, influence, and perhaps even prevent financial crisis, because we didn't have any other instrument, and the monetary policy instrument was not going to be used for preventing financial crisis, maybe for dealing with the disasters afterwards, as Stefan was explaining. But on these objectives, the findings actually positively surprised us, surprised me. If you can see there on the right, most of the readers think that we've been identifying relevant issues, although some think that from time to time we might be overstating the relevance of risk, so we tend to more overstate than understate. Second, our readers say the FSR influences decision-making. It's seen on the right here, and it's not only decision-making on policy and research. Sorry, I don't have my glasses on, and I can't see which slide
That's right.
is up there. So, and I have this small print problem. Seen on the right, it's not only decision-making on policy and research, which we might have expected, but also on risk management. I don't know if you were one of the respondees on this, Ljiljana, but perhaps unsurprisingly, we don't appear to have much influence on investment decisions. So contrarian investors, who would be the natural audience for this, are not using the FSR for ideas. Last but not least, we looked at the leading indicator properties of the language that we use. So using, Stefan was talking about the techniques, technology has improved over time. One of them is this language processing techniques, and it turns out, as you can see on the right there, that the sentiment of the language used is a harbinger of crisis. Sentiment is tended to turn noticeably negative, and I mean language sentiment, about a year in advance of systemic stress episodes. So that's the quick summary. I'm going to begin. We can begin with the format of the panel will be the following. I'm going to be the following. We'll have general reflections from panelists on the importance of financial stability communication, and each will speak for about 5 minutes, and then, hoping that time allows, we're going to try to explore 3 themes. One is about the lessons from the past. lessons from 2 decades. Another is about the balancing act of transparency and market sensitivity that Stefan was talking about, and then forward-looking communication strategies. I will try to open up the floor for audience Q&A before we wrap up. But if audience members have burning questions, please hold that thought until we get to the end of the session. So that lets me come to introducing our esteemed panelists. Vítor hardly needs introduction. He's the former vice president of the ECB, and he took responsibility for 16 issues of the Financial Stability Review, so a quarter of all of the FSRs we published. Yeah. Stijn led financial stability work at the BIS, and he's a renowned academic on financial stability matters. Ljiljana is Group Chief Risk Officer at ING, and she has participated in CRO risk roundtables at the ECB, and you have been, I think, one of our more vocal contributors at those meetings. And then Ernest advises the governor of the Austrian Central Bank and secretary of SUERF. He has been hosting panel discussions of our FSR since the pandemic, and so I think that has also helped with the promotion of our readership. So each panel member brings a wealth of experience, and they bring them from different fields and perspectives, and I'm sure that's going to enrich our discussion. So I'm going to start with the initial remarks. Each panelist has 5 minutes to talk about why financial stability communication is important, about the need for balancing for transparency, and the conflicts that may arise also between objectives of financial stability and monetary policy. So I'd like to start with Vítor, if I may.
Yeah.
Floor is yours.
Thank you very much. And really, I want to start by saying that how grateful I am that I was invited to participate in this celebration of the 20th anniversary of the FSR, and also for being included in a great panel of experts in the field. I think that the Financial Stability Review published by the ECB is the most prestigious and impactful publication in Europe on its field. I still have that view. It is informative, analytically deep, and encompassing in approach, and that's what makes it the great publication and useful publication it is. And so there is much to celebrate about the whole history of the FSR in the last 20 years. So I will pick 2 subjects from the list you just mentioned to start. One is about transparency and the need for communication, and the dilemma that creates, that sometimes giving some warnings can trigger more volatility in the system, and this is always a balancing act, and for that balancing act there are no rules. It's always a matter of judgment. But I want to say very clearly that I think that the authorities, the ones that publish FSRs, should not avoid providing warnings, especially if they have methodologies that provide the basis for early warnings in the phase of the financial cycle, because that's the way to try to impact the behavior of institutions and economic agents before the bad may come and influence their behavior. And indeed, in economics, many times we used to say that the best forecasts are the ones that never materialize, because if they have an impact, if done timely at early stages, then they can change somewhat, at least, reality, and they may never materialize, but they were good forecasts for that reason. So I am very much in favor of publication of everything, because that's part of the preemptive nature of macroprudential policy. In 2016, I made a speech with 6 main principles of macroprudential policy, and the first one was about the need for macroprudential to be preemptive and strongly procyclical. And I think that indeed is a very important principle. This applies whether one believes that macroprudential policy is only about improving the resilience of the system, or if we also believe, as I do, that macroprudential policy should also have the aim of trying to smooth out the financial cycle. In both cases, the forward-looking preemptive nature is totally justified. And one of the implications of that are for the buildup of indicators of financial stress and systemic risk. They must have a predictive capacity to really be useful, not just a portrait of what is the situation today in real time, but also having that predictive capacity. What all the risks of that I just mentioned, but it must be like that, and that's why one of the reasons why I put a lot of pressure on the GMF to come up with two indicators of stress that add those properties. One with an horizon of 1 to 3 years, and another one medium term. They were published, but unfortunately, for whatever reasons, I think that they have been used internally, but not publicly. I understand the difficulties of putting out some predictions or predictive things, but I think, I still think that it is needed in the spirit of what is the methodology of GDP for growth that the IMF continues to publish in every global financial stability report. And in the spirit of a working paper of the ECB of 2021 by Panellists, Stefan Farr, and others about the risk management perspective of macroprudential policy. And that, I think, is the spirit that would be necessary. So I fully understand the sensitivity of the thing and why perhaps it was not too much used, but I wanted to underline this point. The second point is about the conflict between macroprudential policy or financial stability and the monetary policy. That conflict is related, to start with the differences between the financial cycle and the business cycle. And it is now well established for quite a while that the financial cycle has longer duration and builds up very gradually and then ends abruptly. That makes a difference with the business cycle, and that's one of the reasons why there must be a separation between macroprudential policy and monetary policy. An additional reason, of course, is in the monetary union, where we know that business cycle among member states are more synchronous, have become more synchronous than the financial cycle in each country. And so we need macroprudential policy at national level, and monetary policy for the whole is too blunt a tool to be used for that purpose. So I think indeed that although there are interactions, of course, and most of the time there is convergence of objectives, most of the time, but not all of the time. And I don't think, nevertheless, that either policy should at any moment adopt the main objective of the other policy. That means, of course, a rejection, a full rejection on my part of the so-called leaning against the wind monetary policy. It was a good move that the new monetary strategy of 2021 of the ECB states in the general document that financial stability considerations will do an input for the discussion of monetary policy, and that's fine. I am not so fine with the other document, the more extended one called the overview, which was also approved by the Governing Council, where the possibility of leaning against the wind, although not systematically, as it is stated in that document, but depending on circumstances, could still be justified. Just a warning. I addressed this issue in my last speech to the ECB watchers in 2018, and about this potential conflict. There were two phases to it. The first phase in the 90s was about whether monetary policy should have as a target asset prices. There were two schools, Bernanke and Gelcher said no, Doncon said no, should not. Then Cecchetti, here present, was on the other camp, and then the whole team of the BIS was in the other camp. And the second phase was not about that, but about the potential leaning against the wind in monetary policy for reasons of also affecting the systemic risk. And there were a set of papers by Lars Svensson starting in 2015, demonstrating that no, there was no, in terms of cost benefit, there was no really justification for leaning against the wind strategies. Then there was, of course, criticism by Tobias Adrian, Nelly Lang, and others, the BIS team. Again, I think he responded well to all these criticisms, and I asked the staff here to use one of the DSG models to do the same calculations as Svensson for the euro area, which I used in my speech, showing that indeed the costs, potential costs of unemployment were bigger in terms of welfare than the possible reduction of the probability of financial crisis. And then a paper was published the following year by Christopher Koch, who was one of the things. So I still really keep faithful to those views at the time, and so I wanted to address this all very difficult question of this conflict that can be for real in certain moments, not most of the time, fortunately, of course, but it also means, again, that macroprudential policy has grown in efficiency. There are many papers now illustrating that, and I think that we should really have the two policies separated.
Okay. So could I turn to Stijn?
Well, first
on
of all,
this importance of financial stability communication?
sure. Well, first of all, congratulations. It's quite a bit and quite an achievement. I also want to probably thank you for, on behalf of those crises that you prevented, that you never know about. So that's, I'm not kidding, because that's something that we don't get rewarded for.
Could be.
We never know, of
Yeah.
course, but there are these cases that I think you have achieved. First, I want to go even a little bit further than even your introduction and what Vítor said. I think it's almost a duty for us to communicate on financial stability. It's like, wouldn't be not only imprudent, but as a public policy authority, we have to do that. So let's say you would see a bubble that is about to burst, or 3 years from now burst, and you wouldn't communicate it. It's almost an act of irresponsibility. So it goes beyond that, okay, let's do all the financial stability work and then communicate. I think we need to completely think, in some sense, the paradigm the other way around. Communication is the final, most important and powerful tool we have to change people's behavior. Let's make our analysis serve the communication rather than, oh, let's do analysis and let's see later on how we package the analysis so that we get some impact. No, and you and I were part of the surveillance working group that was set up by the FSB to revisit surveillance. And I said, well, let's start from communication. And then the answer was, well, no, let's do communication at the end once we have decided how we're going to produce a new heat map. So I think we need to convince our managers or whatever powers to be. So you've achieved a lot, and I think more generally the FSRs have prevented crisis. I think there is evidence. It's not just that you predict, you do quite well, 2-3 quarters. I have some evidence that it's only a quarter, but okay, you may be doing better than the average central bank around the world. That's already good news. But you also diminished the possibility of the crisis being severe further out, and there's evidence to support that. And again, good reward. One thing, type 1 versus type 2, I'm more tolerant of a little bit volatility. So sometimes we seem to have come to the paradigm monetary policy. We don't want to surprise the market, but then of course we're looking towards the market to give us guidance on how we should conduct a monetary policy. And looking in the mirror is not the right way to conduct monetary policy. I don't think it's the right way either to do financial stability analysis. So we should be willing to sometimes surprise the markets. We can surprise with stress tests. I think the stress tests have become too boring. Let's make them a little bit more exciting for the market so they actually get some value out of it. And we should think of that the same way. Of course, that means we have to think of our accountability. If we have some risk of volatility, we should be prepared for that, obviously. But we should also be celebrating our victories. So we have both the type 1 and the type 2 a little bit better, and we don't always celebrate our victories. And I think we can sometimes on the supervisory side to say, well, listen, let's come with the evidence that in the case of the Euro 2023 turmoil, it was partly because supervision was done and had done a good job, and the financial stability analysis had taken care of some of that. So that celebrates some of our benefits too. Then we have the balance a little bit better in place. And it's often about short versus long term, right? So a little volatility today can save you a bigger problem down the road. So again, not be shy to have an idiosyncratic risk come up at some point in time and a later issue. And part of the answer there is, I have to recall exactly what the tables were because it's been too, what you suggested, Vítor. Bring them back. Let's have standard tables where people can, on a day-to-day basis, for that matter, you have a dashboard out there, observe where the risks are, and then that make their own conclusions. And you don't have to make a big statement about, oh, the risk has gone up. No, the data show that there is more risk in the system, so don't be shy about that. And again, you can help it. I do want to talk about, because I think this is where we're going to disagree, Vítor, about monetary policy and financial stability. Right. I think it is leaning against the wind has some benefits long-term versus short-term. And to be too accommodative has some long, that's not just to be as view, I think is more generally a view that's in your financial stability, monetary policy strategic review. It's another central bank's strategic review. So I think there's a coherence now around the world about this thinking. I do then also make the and I think that's irrespective of whether you have that leaning against the view on how you coordinate. You argue quite a lot for separation, and I think actually we need to coordinate more in some sense. Not coordinating in the sense of policies, but talk to each other. Oh, don't have silos. Do joint analysis. Present things in a coherent fashion. Have staff exchanges. Do all the things that can make the central bank understand these risks, because it's also not leaning against the wind, but it's also when there's an interest rate increase, we saw some lack of coordination, creating a turmoil in the US and other places. So that part of it we should not have seen. We should have had stress tests that had interest rate increases rather than just keep the interest rate low forever.
Ernest, where are you on all of this? The importance.
There are many positions here.
We're already.
I try to add further.
You can be guaranteed with this financial stability monetary policy one. Yeah.
So let me start with your first question, which was the roles of communication.
Yeah, and the importance.
Let me structure it in 4 roles that I see. So the first one, which I haven't heard so much, is it's a tool in itself. I would call it financial stability jawboning, using Greenspan's term for monetary policy. You can do the same thing with financial stability and with an FSR. Second is to accompany what I would call hard macro-pro. So you can prepare ex ante forthcoming measures, like a little bit like forward guidance on macro-pro. Then you can also do it ex post to explain it, to create more alliance, to make the tools more effective. The third is accountability, it has been mentioned. You could also look at it as ensuring long-term sustainability of the toolkit, because otherwise people don't accept what you do. It has big redistributive effects, so you need to somehow convince the body politic that it's
the toolkit. Useful. Which toolkit? The policy toolkit or the analytical?
Macro toolkit. It's a powerful but intrusive set of measures. So you need to ensure acceptance. And the fourth function of communication, like in an FSR, is financial inclusion and literacy. There are huge information asymmetries out there. Small savers don't know when the next crisis will come. Institutional investors know much better. So this can contribute to an equal playing field. Second question, balance the need for transparency without causing harm. I am very much in the camp of you too. I'm very much in favor of standard set of indicators. I mean, why not provide these? And then people shall read out of them what they think appropriate. This creates transparency, but not for everybody. You need to know how to read these. So in the end, you also cannot escape building a story around it. And that's then where you can have the false alarm error, of course. And so you cannot really avoid this. Also in special features and boxes that all FSRs do, you also pinpoint certain topics. So people will automatically say, hey, so what are you saying? Is there a problem? I would a little bit contradict maybe Stijn. I don't find such a big harm in giving a false alarm. You know, if you say in the early phase of a bubble, hey, there might be a problem, and then it turns out that it was wrong. Well, okay, so some people lost money, but maybe in some cases you also prevented a crisis from happening. So the loss function is asymmetric.
Yeah.
So I would really err on the side of caution there and rather do a false alarm. Final question, financial stability and monetary policy. That's an interesting one. Nobody has, yeah, I heard it in the beginning, financial dominance. I think you used it.
No.
I mean, you're,
No.
I think it's a major issue.
I am against financial.
You're against the term, the concept.
Are you talking about public finance dominance?
No.
Not
Okay. Fiscal dominance, but financial
dominance. Yes.
In this
Now
case,
I am against that.
You're against the dominance of or the concept. No, let's
No, the dominance.
Ernest,
I
continue.
am against both.
I don't need to explain to this audience
Yeah.
what financial.
No, of course not.
I would go further. You know, I would say some claim that this may have played a role in the late phase of QE and forward guidance. You know, we tied our hands. The ECB emphasized. I was actually also involved. We invested a lot of resources into creating the TPI. Well, actually, in the background, inflationary pressures were building up, and we didn't invest into think about how to end QE, and we delayed it. So a little bit, there might have been financial dominance. I'm no longer officially a central banker, so I'm allowed to say that. Vítor,
But this is a conference about financial stability, just for the remind the panel.
Vítor mentioned idiosyncratic shocks in national economies where two tools, according to Tinbergen principle, are useful, of course. The interesting thing is that if you are in the country, like myself in Austria or wherever, it might appear different. You know, they see, monetary policy is easing, while macropru is tightening. And people perceive this as a contradiction. They don't have the bird eyes view, you know, understanding why we do this. Third aspect is that macropru can also aggravate monetary restriction involuntarily because it works with substantial lags, decision lags, implementation lags, and so on. So take the situation now. Real estate downturn in Austria, and macropru has just tightened. So two shocks at the same time. Regarding Vítor's opposition and your support of leaning against the wind, I want to come back to Stefan's, you know, conceptualization of macropru, which goes very much in the direction of my thinking. So I see macropru. You said macropru is monetary policy without admitting it's monetary policy. So my view of macropru is monetary policy at a later point in the monetary transmission mechanism than interest rates. It also affects financing conditions, like monetary policy. It affects aggregate demand, like monetary policy. I mean, it can be sectoral, that's fine. But in the end, it's a demand management tool. And so this, in my view, argues in favor of looking at these two policies jointly, not necessarily making it one tool, not at all, but really looking at it jointly and in an integrated way. Thank you.
Ljiljana, these conflicts are not probably issues that you're thinking about every day of the week. I mean, but the issue on the conflicts, sorry, I mean, Ernest, you said something very interesting about the asymmetry in the type 1, type 2 trade-off, that we shouldn't worry so much about being wrong.
Yeah.
I don't know, Ljiljana, you're a risk manager, you manage risk. What do you think about that? I mean, and more generally about the...
My body language says what
yeah,
it is.
because you have a board to explain to one of these.
I learned today that I need to be very compassionate with central bankers because they are in the same position as risk managers. They're always guilty and they've never done enough.
Absolutely.
So that's obviously why I feel so close to the central bankers, because I am a risk manager, and usually when things are going well, no one needs you and they question even your role. When things go bad, again, actually everyone needs you, but they push also on the responsibility towards you. So maybe going back to the topic, and I'm not going to repeat a number of the concepts that have been said, with majority of them I agree, but maybe first of all, I'd really like to congratulate on 20 years of a great job, because I think it has, I'm sure, prevented a number of crises that we haven't seen. And that's exactly what it should be the aim of this communication, is to be consistent in the messages to the market and then to follow with the policies and with agendas in order to prevent that from not happening. That for me would be a successful risk management within the banking terms, but I would say in a policy framework that would be a very successful management for financial stability. So that's first. Secondly, on the topic of false alarms, I have a bit of different views, because one of the major values, in my view, of this communication to the market, and in the end you communicate to a number of different target audience, is actually to buy in the market in belief that this is happening, and to create your credibility and not actually raising it all the time like a weather alert. Tornado is coming, and then after 5th time, no one's going to go in the shelter anymore. So that's a bit my point, and this is where maybe there is a mismatch in between how maybe private sector and real economy looks at sometimes these types of communications, if they are not, I would say, nuanced. And I really congratulate to ECB on the way how they develop their communication strategy, because I do believe you can find for everyone a level of information, being it quantitative or qualitative, that different target audience require. For example, us as practitioners in the banking, we can understand and we look very deep in all of the analysis. We really slice it up and down and think through it. Financial newspapers maybe just need more of qualitative data about it. And you very successfully follow up in the speeches, in the interviews, in the different papers and publications. And I think that's exactly how it should be, the consistent message through different types of communication for different target audience, that the understanding is there. False alarms, I would manage them through nuancing, because you can say the same things by creating an alarm and not creating an alarm. And here definitely social media doesn't help, because they would go very direct, very short, very non-polished, and that can create a crisis. And that's why I believe the role of the ECB is to get this nuance on where do we stand in the cycle and what could happen in order not to create the panic. I've heard also the point on surprising the market. That's probably the nightmare of every person sitting in a private sector. When it has market communication, you don't want to surprise the market, because any surprise, like a risk manager, you don't want to surprise me. Every surprise is negative. So I'm a bit against these surprises. I would say you need to teach the market, nuancing it, what you're going to say, what you're going to do, and then more importantly, your follow-up actions through policy need to be consistent with what have you preached. And if you gain this credibility in the eyes of the external market, in the eyes of the investors, newspapers, private sector, I think there will be more unity and thinking around, okay, this is what has been seen as a shock or potential shock or a risk to financial stability. What do we do about that? Do we drive it into direction that this does not happen, or do we just think that's another panic coming from some people that are only having a bird's eye view? So I'm a bit more, I would say, thinking in direction that it should be nuanced and it should take by the hand actually the markets rather than surprise them.
So I mean, on this first round, I mean, I've actually been surprised. Surprised by how positive you have all been about this tool that we wondered at the beginning, did we have? I mean, I remember after the global financial crisis, I mean, we went around and talked to market participants and asked them, had they been reading the Financial Stability Review, you know, and what happened? And you know, I mean, I think the answer that they gave was that they didn't see necessarily what the policy follow-up would have been to what we were writing. We didn't have a policy toolkit, and I'm kind of wondering, has the fact that we have a macroprudential policy toolkit now changed the way the market thinks about that we're going to follow up? I ask also because I started my career in monetary policy, and looking at the market reactions to speeches and all this kind of stuff, we knew what reaction we were looking for from the messages that we were sending out, but it's never been entirely clear to me what market reaction you would want to get from a financial stability review. I don't know. Ernest, you said it kind of doesn't matter if we get it wrong. Ljiljana's talking about the importance of, you know, and I think one of the reasons why we have this weighting on type 1, type 2 errors is because of the reason of we don't want to lose credibility that we're going, you know, I think it's part of the culture of being in a central bank that if you make a mistake, it's going to be remembered. I don't know if any of you wanted to pick up on that, because I think it's one of the things that has come up over the last 20 years or so. Any of you? Vítor? Yeah.
No, I mean, we all talked about it, and I think that in the end we can find a consensus, because first, I think that communication has to be preemptive, and that means it has to be forward-looking. And that means also that it entails some degree of risk in making those early warnings about what may happen. If that part is not delivered, I think there is something missing. The definition of systemic risk that the ECB adopted is there is systemic risk when there is impairment of the system in delivering products and services to the point that can create negative real economic activity effects. Which means, in fact, this definition goes in the direction of the GDP at risk, that it is adopted and is forward-looking. So we have to accept some degree of risk. I agree with the language of being nuanced, but the warning must be there. And the risk has to be, and then, of course, it can always be explained, as I tried to remind you, that we all know that the best economic predictions are the ones that never materialize for a good reason. So we have to accept this and not be too much concerned about, you know, the false alarms. But with the nuanced language, I agree with that part, and I hope that can establish sort of consensus among ourselves.
Stijn, what you said was really interesting about that we had actually prevented crisis. You know, I did a podcast recording on Monday, and my interviewer kind of chuckled at the idea that we would have prevented crisis. And now, Ljiljana, you're saying it also. But I mean, on this issue of the asymmetry, I don't know, we'd call it the risk aversion in communication. Where are you on that?
So, well, first of all, on being coherent, I think that's important, and implicitly, and Ljiljana mentioned as well. So if you come and you predict something about a crisis going forward, which you have evidence, as you showed, and I think that's a general finding, the next step
That
is
we
also
warned,
that you warned.
but you're saying, you're going even further
I'm
and
going
saying
fur-
we prevented, and I
Yeah,
think
and you-
Ljiljana said it too.
The evidence is there that you can actually change the cycle meaningfully to reduce the risk. I mean, maybe you don't prevent every crisis, but that part of that prevention part is only there if you're coherent with your follow-up actions, because then you need to do macroprudential policies to reduce the risk, maybe even monetary policy to be preemptive, but some other tools as well. And if you have that coherent perspective, that's partly an institutional feature that some countries have and some countries don't have. So do you have macroprudential policies within the central bank? Well, that makes it more easy to be coherent. Those that don't have that have to rely on somebody else. That never happens, etc. Stefan, I don't know, maybe your country in that case. So you have that part of it has to be there, and that has to be internalized. When you do your predictions, I'm going to follow up, and then I feel will be more credible going forward. Then your type 2 problem of having bad false alarms. Like I said, I wouldn't want to go that far as Ernest got, but live with some volatility is acceptable in my terminology.
Any thoughts, Ernest, Ljiljana, on this point?
Maybe just to add, I agree fully. Again, nuanced. Our job is to worry. I always say, when investors ask me, are you worrying? My job is to worry. That's why I'm a risk manager. So that's probably also our job here. But what I think it's important that it resonates with the markets, so that it's not out of the blue, that it's not something that they see absolutely opposite, because then the credibility is theoretical and it's not being really placed into what does it mean for the market. So if we are able to bring this from the theoretical level into really how does it display onto the real economy, I think that brings more credibility to what we are saying.
Yes. Ernest, yes.
So I really take your point, this consistency to avoid unnecessary shocks. So let me put it like this. Ideally, with full credibility of a supervisor, then booms and busts would not happen. The market will always be correctly priced because they expect action. But, if I take the monetary policy analogy, this doesn't even work there. It's not enough to just say price stability, we keep price stability, we keep inflation at 2%. In the end, we need to take action, hard action. And the same is true for macropru. In the end, we also need to take hard action. And as with monetary policy, where markets are correct, adjust, prices adjust, this means losses for somebody. Risk managers then ask, well, what did you do? Why did you not anticipate this? So the same will happen with macropru. And it may be a possible solution. I'm not so much into the academic literature on this, so maybe the idea is not new. But maybe to put your idea of preparation, avoiding shocks, and so on into different words, is that one could make clear to the markets what the supervisor will do by sort of clarifying a reaction function of the macropru policymaker. So by analogy to a monetary policy reaction function.
I just wanted to say one thing back to what Ljiljana was saying about not coming out of the blue with things that our readers don't expect. I mean, this is one of the reasons why we place a lot of value on market intelligence. I mean, having a dialogue with the financial industry, and not only, risk managers like yourself, and also people who are investing in the market. One thing, I think we've been kind of looking we spent quite a bit of time on communication during tranquil times, before crisis, warning, the crisis prevention role. But everything can change when you get it wrong and the crisis does actually happen. And that's something that I think, an experience that we shared, Vítor, during your time. publishing a financial stability review during a sovereign debt crisis, what were the lessons to be learned there? You know, because you can aggravate. Some central banks in the euro area even discontinued their financial stability reviews on account of sovereign debt crisis. So we didn't.
Before the sovereign crisis came the banking and financial system crisis. So, and I start there. I think what happened with our FSR was indeed that we reacted quite quickly to the facts of the financial crisis. Unfortunately, like everyone else, almost, some individuals claim that they predicted exactly the financial crisis, but institutions, no institution predicted the thing, and we didn't either, that it was going to happen the way it happened at all. But after the fact, we reacted quickly because we started to develop new stress indicators. And in particular, we started to publish stress tests. We started publishing stress tests, top-down stress tests, in 2011. And then we published a working paper in 2013 with the first methodology that we were using in the top-down stress tests. And we did it for banks and for insurance companies. And we did it with all the risks that it entails, of course, but I continue to think that it is a useful instrument, as Stefan Ingves said, and I agree. And we were continuously advancing in the methodology that was built up here. And in 2017, we had the publication of an ebook called about the system of STAMP, which was a system of models, a modular thing that was quite encompassing because in different models, it did interaction between different parts of the financial system. It included optimizing behavior by the part of the banks in terms of the reaction to events. So it was a dynamic approach, not a static approach like in the stress tests. It had an overall liquidity test to the whole system. It was included in one of the modules. It included also the interaction with the real economy, and it including very explicitly also the interaction with the balance sheet of households. All that was part of STAMP that before I left started also to include investment funds in the encompassing view. So I hope that STAMP was not discontinued and still out there and could be and should be used. Because in 2020 came another innovation, which was, of course, very useful, which was the integration in a semi-structural model for banking of euro area stress tests called BEAST. That was only about the banking sector, but it was a large semi-structural model, including the real economy, the interactions among banks, and all of that. So a very nice thing. And then in May of this year, another very useful working paper was published by the ECB in May, which has a survey of these developments and what is the state of the art within the ECB about these matters. So with all these apparatus out there, I understand that in 2022, the publication of stress tests was interrupted. Well, it was a big crisis, big shocks, difficult to predict, so it was interrupted, but I very much hope that it will resume one of these days, because I still defend these preemptive, forward-looking methodologies that are very useful, and that the ECB has such a good apparatus to continue to do top-down and system-encompassing stress tests that they should be used. Otherwise, some others will do it. So that's the hope I express, because I think it was a continuous progress of
Yeah,
the
but I think
at expert level of preparing all these analytical tools to be used in a very useful way, with all then the same type of risks that we discuss about the stress indicators and all of that.
So necessity
Yes,
is
my view.
the mother of invention. Crisis is the mother of invention.
Yes, and then we
yeah,
really
and we should increase transparency even
yeah.
during crisis.
Yes, absolutely.
So
Then
is that- I
we
see-
sharpened the list of risks that
Yeah.
were published, and with different colors and all of that. So that was another element of the reaction to the crisis.
We
So
did.
there was, I think, a quick adjustment to the needs that were created by the crisis, which the main lesson of the crisis was the awareness that micro supervision was not enough, because the individual institutions could seem to be more or less okay, but we discovered that there is systemic risk, and it appeared. And that was the main lesson of the crisis, in my view. The second main lesson is that a crisis in the real economy may come from the financial sector. These were the two main lessons of the crisis, and then we should act upon that forcefully, and that's at the level of an FSR. That's what we tried to do.
Any thoughts from the other panel members on this? I mean, adapting to the situation, adapting the communication to the situation. This is one thing. You know, becoming more transparent, becoming developing and so on, models and so on. Another issue, maybe I don't know. I thought maybe Ljiljana, you might have had some thoughts on this one. You know, the frequency. I mean, we decided on a semi-annual frequency of communication. Not everyone has that, and we're kind of, it comes up from time to time. Should we do it quarterly? Should it only be annual?
Not quarterly, no.
Would you like to see a quarterly financial stability review? I'm not saying that we will be delivering one, but it seems to be the industry standard.
Mrs. Lagarde this morning somehow stole my attention catcher about the pages, because that was something that I planned to start with, and to thank you for having half to read. So twice a year is okay. Do not make it 4 times a year. Otherwise, I would expect further shortening.
It's the old story about the Irish
No,
son
don't
writing the letter to his
part.
mother.
I think the dynamic is fine. I really find it not too intense and timely. There is always a possibility clearly to go with an ad hoc, but it needs really to be well situationally explained. Otherwise, it can create eventually crisis, because it's also very questionable in which point of time do you have sufficient new insights and information to intercept the next 6 months communication and go earlier, that really could, I would say, signal something to the market. So I would say that the frequency is fine. The quality is really, as I said, really, very honestly, is very good. We really learn a lot about out of it. We use it a lot. It's easier to have the boardroom discussions also with this document, so it really helps, and I'm really grateful for. I'm very happy, and you mentioned it before, that you have worked on what we, I think, as industry also have mentioned a few times, on keeping a mind open to what you hear and see in the real life, in the industry, from the CROs, and embrace these views in your views. Why? Because, as I say, then it resonates more, and we know that vulnerabilities usually come out of the areas that we might not expect. So if you're creating a kind of a confirmation bias, and this can happen in this kind of activities, it could be dangerous. So I'm really happy that we're having this also discussions twice a year with you, exactly, so that you hear what's happening and that we hear what's happening. I think that definitely is helping. So on the format, really do not have any comments. Again, I would just always urge you to be consistent in what you're saying through different tools, and I've seen this that consistency in place. But maybe when it comes to the macroprudential side, I might jump into it a bit later. What hurts the private sector most here, and specifically global organization as we are, that's maybe another topic.
Okay, thanks, Stijn.
Yeah, I wouldn't go to quarterly. I think that's demanding also too much of the audience.
EIS is a quarterly.
That's
report.
the different product. But
Is
no,
it a
but
financial?
you're gonna lose your audience. Maybe
Yeah.
other people think
Correct.
about it differently, but
Yeah.
I think it's too much to read. And I do think in terms of coming back to my point, standardized output will make it easier to read. But also that doesn't mean that you should be standardized ever. You definitely need more transparency in times of stress. The stress tests showed that how much value could have. A crisis is about a coordination issue, right? We don't know what's going on, who's doing what, and presumably you guys know a little bit more about the system as a whole. So you want to bring that out in a responsible manner, not in an irresponsible manner. But as part of that transparency, and back to my standardized tables, can we make an agreement that the 25 years of FSRs, you're going to have the equivalent of call reports of commercial banks available for the European banks? That would be the US call reports, right? We still have no transparency of a very basic part of the financial system, which is the banks. That should be downloadable in an instant for all the European banks. Second, the non-banks, we're probably going to be talking about it more in the next session. You already can do a lot more than the market can do, putting pieces together from various sources. Put it out there. Special features for the moment, little boxes. You learn, you get feedback, and eventually something standardized will come out of it as well. I think there's a lot more innovation in that area.
I agree. I mean, the non-banks financial institutions is a very important topic. The FSR has dedicated over the years many features and boxes to the non-banks, but not much has happened in reality in terms of regulation and policy. And I plan to address that also, but we have no time to do it. I just want to flag that in my complete speech, which I will post in the platform Substack. So please.
I think we can put some of these materials up after the
Yeah.
conference if you
Yeah,
want. Let's go. I mean, I think we covered a lot of the topics that we had kind of agreed that we would cover in this panel. But there was one thing before I ask the audience if they want to ask a question. Ernest, you said something interesting in the first round about the role the financial stability communication could play in financial literacy, financial inclusion, and equal opportunities. I mean, what did you have? What did you have in mind there? It would be a bit outside of the scope, but I mean, sometimes, some people say we publish a financial stability report, not a financial instability report, and why not talk about the things that make financial systems stable? I don't know if that is what you're getting at, or, we have capital markets union and all of that, inclusion, getting savings deployed more effectively and so on. Is that a role for financial stability reviews?
Thank you for the question. I think you can answer this both from the perspective of a financial stability review and a financial instability report. So both aspects are important in this respect. So I said before that the main function from this perspective is reducing or abolishing, ideally, information asymmetries. In other words, to create a level playing field, fairness. So first, we want to avoid that the less informed savers are left behind and are taken by surprise by booms and busts and by turning points that the insiders, the institutional investors might suspect are coming, and the other people are just learn about it when the crash has happened, in other words. So this function would be warning against financial crisis, against price corrections. And the other aspect is that you just alluded to is if you do this consistently in such things like a financial stability review or in financial literacy in general, you create trust by non-professional savers in the financial system. And I think this is a precondition. I can just talk from my country. I mean, I think the same is true in Germany and many other countries. So we always wonder why, compared to the US, people don't save in stocks and not even in bonds. Has increased a little bit due to the low interest rates, but it's still the case in Europe. Well, there is no trust, and people are actually distrustful. They think that financial markets are
markets.
The markets are, the people think that the financial system are a bunch of criminals. They don't trust the system. So, and why do they think so? Because they don't understand it. So I think we need to explain, and a financial stability review and the layered communication that you add to it. It's difficult, but I mean, you have made it one of your missions at the ECB under President Lagarde, and I find this very good. I think this is important, and I would label this. So the aim is to correct excessive risk aversion through better information, to avoid that poorer people lose out on the higher return possibilities.
Yeah.
Because of.
I fully agree with your objectives, but it's not for the FSRs. The FSRs, in the end, are for specialists, really. These reaching out to common investors and so on has to be done and should be done, but via our instruments.
So we have in this.
Sorry,
Yeah.
but
Otherwise, you simplify.
no, sure. But
but
look
the
at what.
masses will not read the FSRs. I guarantee.
You might be true, because
Well,
we
have
compete against much.
We can get it
more
into the
attractive.
newspaper. We
So-
can get it into
so-
the newspaper.
yeah,
We can get
well,
a news headline
okay,
or something.
And look at what
We
the
have
ECB
today,
does the monetary policy.
No, but okay, but
Very simple.
Okay, there's always
Language.
discussion about new territory, but we had today a special feature on, how inefficiently banks allocate capital in Europe. It's a second special feature. Author is here, and we're wondering about whether or not this should be the first in a series, or not, to show, that especially at this time of low productivity in Europe and so on, which is a bigger issue. So we're going into coffee break time, but I'm sure there must be a couple of people in the audience who have burning questions. I think we maybe have time for 2, 3. If you do, please put your hand up first, and then, I don't know, we have a couple of people with mics at the back. And then I would ask that you state your name, organization, even though I know you, Carsten, and for posing the question. And maybe you could also say who you're addressing the question to.
yeah, that would be helpful.
Okay, thank you. I'll be short, but I can't refrain from making a comment on the monetary
Please.
policy.
Leaning from the wind.
You knew that.
Leaning against the wind.
Yeah.
No, not leaning against the wind.
No.
No.
But I'm trying to reconcile some of the views I heard, and my question to the panelists would be whether you could agree with that. A short yes would be fine, but
Yeah.
so
No.
There you go.
Well, let's hear, Carsten.
so can we not start from the assumption that monetary policy is a risk to financial stability? It can be a risk to financial stability. There's more and more research out there showing that monetary policy is one of the best early warning indicators for systemic banking crisis, especially like a U-shaped monetary policy. This includes low for long and swift tightening. So there's evidence out there. So let's not deny that. Can we just accept that? If we do that,
Brave question.
if we do that, there would be times of conflict between the two. But this conflict would vanish when the financial sector is sound and safe. Because then monetary policy can do whatever it needs to do to maintain price stability, and it wouldn't matter. The conflict is immaterial.
The question is what you're making a long statement. What is the question?
So the question is whether we can agree that there is no conflict between the two and we can separate, as Mr. Constâncio, you said, if the financial sector is sound enough, that's the role of macropru. But if that's not the case, then we better inform each other. So that's why we, after following the strategy review, we are producing this information for the Governing Council. What's the shield of macropru delivering? What would be financial stability consequences of certain monetary policies? So that then this kind of coordination is important. So thinking whether this could be a compromise and whether you could agree to that. Thank you.
Are you able to give a quick answer on this one? I know you would really like to talk about this one. But
Yeah, well, no. Well, yes to the need for continuous dialogue between the two parts. That's important. But there are situations in reality where the conflict exists because the overriding objectives of each are different. When we had those more expansionary monetary policy, inflation was very low, and the objective of monetary policy is inflation, especially in the euro area. That's the case. And so that conflict indeed was there. Most of the time, in normal times, the convergence exists, and there should not be any sort of conflict. And by the way, let me say that I don't agree with Stefan that macro-pru is monetary policy with other name and other tools. It's not, because I still keep a difference between the financial cycle and the business cycle, and also that financial instability as a target is indeed in the end somewhat different from the objectives of price and macro stability of monetary policy. But yes, under this understanding and this condition, yeah.
One more question, if anybody has one. There must be one, at least. No?
Coffee.
Coffee. Stefan Farr, you put your hand up.
Stefan Farr, yeah, good.
So,
A very short one.
who, your name? Okay, I gave it
Yeah,
your
Stefan Farr
institution,
from
and who
ECB.
the question is for.
The question is for Ernest, actually,
And
predominantly. So it's about the volatility and financial stability communication. So on the monetary policy side, what I observed like 10 years ago during the post-financial crisis and thinking about QE, it was often stated that, it should be effective, but we shouldn't do price distortion. And seemingly then the corresponding one on financial stability side would be, well, we want to change behaviors with FSR communication, but please do not do volatility. Maybe both concepts do not work in either case, both for monetary policy and financial stability.
That's for Ernest, was it?
Yes.
It's a tough one. I've been thinking about a little bit of a related issue. I think even in the chapter, it is stated that one aim of financial stability communication is to align expectations and views. And this is what we commonly think of monetary policy communication, try to align expectations and views. Seems very logical that this is a good thing. But on the other hand, it also bears on the other side the risk that we all move in the wrong direction then collectively. What if the central bank gets it wrong in the FSR? I know you never would, but what if? And we align market expectations that there is no problem. And then in the end, that turns out to be a problem. Then in this case, this alignment of the initially wrong expectations might actually aggravate the boom-bust cycle. And the volatility, well, also with respect to monetary policy, I'm not so sure whether we should eliminate all volatility. And I'm here with you because it allows, allocation of resources. So you shouldn't eliminate all. You should also not eliminate all relative price adjustments in the goods and services market.
Okay, so I think
may I introduce?
30 seconds.
No. About price distortions done by policies. I remind you of the quote from Bernanke saying when QE was very much criticized, and he started it, as we know, and he said, well, we started because the market produced price distortions, and the consequences for the economy as a whole were bad, and that's why we intervened. So the idea that when markets work, the prices are not distorted, there is no problem, they are perfect, the markets should be countered. And this quote by Bernanke is quite useful for that purpose.
I think that was, very helpful to end on that point. So, I mean, in concluding, I heard a lot. I actually, we have these discussions often about, what we're doing, the effectiveness and so on. And I actually heard some new things today. But I mean, so I'd like, I heard, Well, look, I mean, I was actually, communication is important. Okay, we wrote an article about this. We help risk managers. This was new for me, what you said. I mean, did we help your credibility at the board? It was great to hear that. We create trust. It's a duty. We should enhance transparency during, this is something I think we already, I mean, it was a bit learning by doing, as Stefan explained. And I also heard, I mean, one of you almost said it, let's make stress tests great again. So let me thank each of the panelists for these really thoughtful insights and our audience for the engagement. I hope you enjoyed the discussion. I certainly did. And I also hope you enjoyed the second half of our forum. It's going to be moderated by Cornelia.